I just received this question from a subscriber. Colin, with interest rates at some of the highest levels in the past 20 years, should I keep my funds in my high yield savings, lock them up in a bank CD for a year, or invest in a Treasury bond? That was such a great question, and especially now. And I'm sure many of you are wondering that same thing. So here is my take. I rarely advocate for an all or nothing strategy. I am a big believer in diversification to grow and protect wealth. So having some funds in high yield savings, getting the higher short-term rates, and some locked up in either CDs or Treasury bonds makes a lot of sense to me, but every situation is different. You know what doesn't make sense to a lot of people? The inverted yield curve. I created a short video about the inverted yield curve back in the summer of 2022, and it's still here.
Normally, investors receive more interest the longer you lock up your money, right? However, from time to time, the market moves interest rates to the point they become inverted. Shorter-term bonds and CDs yield more than longer-term CDs and bonds. According to my economics degree, this should never happen, but it does. And when it does happen, take notice. When short-term government bonds have higher yields than longer-term ones despite carrying lower risk, these yield curve inversions are often viewed by markets as a sign we're headed into a recession.
In theory, that should never happen. You should never get a higher interest rate in a shorter-term lockup period, but that is exactly what we see now. An anomaly that usually only happens when a recession is likely. The markets are incentivizing you to keep your money in short-term lockups to earn more money. But the markets are also telling you that their belief is that interest rates will decline in the coming years. This is why rates are lower currently for longer lockup periods. This is a perfect spot to point out important disclosures before we go any further. The information in this video is for educational purposes. This is not specific financial planning, health insurance, or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. All three of these options are generally very low-risk ways to preserve assets. High-yield savings accounts. FDIC insurance up to $250,000 per individual, per bank, or $500,000 for a joint couple. The interest rate can fluctuate at a moment's notice, and the interest received is fully taxable at the federal, the state, and the local level in the year you receive it. FDIC insured CDs. Same insurance benefits, and the interest received is fully taxable at the federal, state, and local level in the year you receive it. The major difference is the interest rate is locked in and will not change for the term. U.S. Treasury bill or bond. No FDIC insurance, but a potentially even stronger benefit is that the United States Treasury has to default in order to not be paid. There is no dollar limit. And if that happened, we have bigger fish to fry. The interest rate is locked in and will not change for the term. The big difference here is that the interest is only taxed at the federal level. State and local taxes are not paid on the interest on Treasury bonds and bills. Now, often, Treasury bonds are better than FDIC insured CDs for those people with higher asset levels, higher incomes, or those that live in higher tax states. They're also slightly more involved to invest in, either buying directly from the Treasury or through a brokerage account. Sometimes the familiarity with the CD at a local bank is just easier to understand. Even though the net return may be lower, jumping through a couple additional hoops sometimes isn't worth it for a few $1,000s. You need to understand yourself and make the best decision for you and your family. Okay, now that we know the differences between the three and who they make the most sense for, should we even lock up our money? Interest rates are slightly down from their highs early this year, but they are still at some of the highest levels we've seen in recent memory. Will they stay at these levels, rise even higher, or will the Fed try to bring them back down? Well, the Federal Reserve usually follows the 2-year Treasury and raises or lowers the overnight rates based on what the 2-year yield is doing. Just have a look at this chart. This chart is about a year old at this point, but you can clearly see the 2-year yield and the Fed rate following the 2-year yield up and down over the past 25 years. Here is the chart of the current yield on the 2-year Treasury in May 2023. You can see it is down from its March 2023 high. And if that trend continues and we slip further into a recession, I could easily see the Fed lowering interest rates back down to reduce the depth and the duration of a recession. That means current interest rates could be as good as it gets, and these rates could be unavailable in a year or even in 6 months. Of course, the opposite could also be true. We could have a reacceleration of inflation, no recession, and the Fed could be forced to jack up interest rates even further. Just watch the 2-year Treasury for clues on where interest rates are going. So back to the original question, what should you do? Well, in my opinion, a diversified strategy of having some funds getting the elevated high-yield savings account rates is smart, and having some funds in either FDIC-insured CDs or Treasury bonds that mature in 1 year, 2 year, 3 years, 4 years, and 5 years can help you capture the current higher yielding rates, but also provide some benefit if interest rates come back down. And if rates continue to rise, well, guess what? You have some funds maturing every year that you can potentially reinvest at higher rates. A key point to understand is that when locking up your funds, you want to understand the risks involved. What if you need the funds early? What are the potential penalties? How much should you lock up and what maturity? There is no one-size-fits-all strategy. This is where working with a good financial advisor who understands your personal situation rather than some internet guru may help. Good luck, and make sure you watch this video next to learn more about the pros and cons of high-yield savings accounts.